Following up on the double top and double bottom strategy, today we're going to learn about the 2618 technique. And the 2618 technique is essentially a less aggressive way to enter a double top or double bottom. So if you're a trader that needs a little bit more confirmation that the trend is indeed ready to reverse, then this is right up your alley. Or if you're one of the traders that either missed the original entry due to maybe you just didn't see it, maybe you're at work taking the kids into school, something like that. Either way, if you missed the original double bottom or double top entry, this is a second chance at getting involved in that trade. Now, because it's a less aggressive approach, we're not going to see it in the market as often. But when we do see it, it usually provides us with pretty good results because it's a safer opportunity to get involved. So initially our 2618 setup starts off just like a double top or double bottom. So we'll see the market push up, we'll see the retracement, and we'll actually have a valid double top here. Now, unlike the double top strategy where we would sell right here and expect the market to go down, we're looking for a little bit more confirmation with the 2618. So after the initial double top is made, we're going to wait for the market to break and close below this valley level. I don't have a fancy word for it, but it'll break and close below the dip. So again, the candlestick needs to create a lower low, lower close once it gets to this dip. Why is that important? Well, because once we break structure, what do we have? Well, we have the start of a new trend, right? We have a new starting point, followed by an initial structure low, followed by an outside return, essentially, because we don't create a higher high, higher close. And then once we get this new structure low, so again a lower low, lower close, well, this gives us more confirmation in that double top. So a little extra confirmation saying that this pattern is going to hold and we may indeed see a reversal in trend. Now again, we never know 100%, but it's a little safer way to enter. And well, here's how we do our entry. After we get our new structure low at this point, after we break and close below this level, we wait for the market to come back up and retest the valley or the dip of our double top. Now, originally, the plan was to take a Fibonacci retracement and we wait for the 618 to be hit, hence the word or hence the name 2618, the 2 standing for double top, and then the 618, boom, 2618. But as we've looked at this potential trade more and more, there are two ways you can take it. It's going to be very similar to a trend continuation type setup. You can either look for the 618 retracement taken from our second top to the new low point created, or you can look left at this structure level. And when you do your back testing, I recommend trying both out, see which technique works for you. But the key is we're either looking for a 618 retracement or a retest of structure looking left. And at that point, then we're looking to sell in anticipation that the trend has indeed been reversed and we're going to see a continuation of the trend in the opposite direction. Let's go over one more in a bearish setup. Again, the first thing we do is we start off with our initial double bottom. Next, we need a break and close above this level. So a higher high, higher close above our peak here. Once we get this higher high, higher close, this gives us confirmation that the trend is indeed going to reverse. And now we can look for an entry point to hop on. So what do we need? We can bring in our Fibonacci retracement tool. We can take our swing low to swing high. And we can either look at two things. We can look at structure looking left, or we could look at our 618 retracement as an opportunity to buy this market up and hop on the new trend. So let's take a look at a few in the actual market. And yep, all right, here we go right now. So you can see we have our double top. We have the market spiking up. And actually, let me change the colors of these candles to make it a little easier on the eyes for you guys. Let's make this blue white, so you don't get too confused here. There we go. And of course, I lost my example, so let's just scroll back and see if we can find one. All right, so here we go right here. Market makes our initial move up. You can see what happens right here. RSI goes overbought, giving us our first top. We then retrace, and we actually get our double top right here. Even though we push a little higher later, this would have been our entry for our double top. We can put another arrow in there to make it easier on the eyes, and we can look down and we can see that we have a nice amount of RSI divergence as well. So say you're a trader that's either missed this opportunity, either you're away from your computer, you're out at work, at a meeting, maybe spending some time with the kids, or if you're a trader that just needs a little bit more confirmation, here's what I would wait for. You wait to get a break and close below this low point. Again, the wick of this candle right here is the low point of this double bottom pattern. So what we need is a lower low, lower low, lower close beyond this point. You can see we get that right here. If we look at our red candle here, what do we get? Market breaks lower, closes lower, giving us a lower low, lower close. It's at this point I'm looking for either a retest of structure or a 618 retracement. So I can take my Fibonacci retracement tool from my swing high of this entire pattern to my swing low and look for a retest of the structure level, which we get right away, or a 618 retracement, which we don't get in this case. And if we pulled it down, maybe we'll get it right here. So as the market pushes down, we retest structure, and then you can see the market ebbs its way back down. Let's see if we can find another one right here. Another one. Market pushes down, gives us a valid double bottom this time. We push back up. You can see my blue line. What do we do with this on this white candle? We get a higher high, higher close. Market then retraces back into the structure level. Again, in this scenario, not quite hitting the 618, and this is what we notice happens frequently, which is why we adjusted the rules from needing to hit the 618 retracement to just needing to hit structure as well. But again, this is something that you would need to go back and back test and see which one you're more comfortable taking. But either way, comes back to this level, and this one actually retraces a little bit further in this case, but eventually still goes up to give us a win. And we'll talk about entries, stops, and targets as always a little bit later. Right now, I just want to get you familiar with looking at the pattern setup. You know, getting your eyes used to seeing this, to seeing that double bottom, which you should be familiar with by now. Seeing that break and close above, and then that retest. Let's see how many more we can find here. Not quite a double top there. Scrunch up the chart a bit. Always makes it a little bit easier. Trying to look for a clean one for you guys. I don't want to confuse you this early. Here's actually a really deep one. This one's going to be a little bit harder to identify, but you can see the market pushes down. We actually get our double bottom right here. It's a sloppy looking one, but it's a double bottom. The market then pushes up, retraces all the way back down. We get a deep retracement, but you can see we don't get a lower low, lower close above our initial double bottom level, and then the market spikes back up. It's a little sloppier one, but again, in the live markets, these things aren't always pretty. And as you get used to identifying these patterns, you're going to be able to identify the more difficult looking ones as well. But same thing right here, double bottom, 1, 2. We have our break and close above right here, this white candle. We continue pushing up. This time we come back, you can see, past the 618. And the 618 comes in right at structure in this instance. Even if you entered here, you still have a winning trade. See if I can get one more for you. One more. That one doesn't retrace. See if we can get a different. Let's try euro dollar. Get a different pair. Okay, so here goes one on Aussie dollar. As always, before I identify it for you, I want you to take a look at this chart and see if you can identify the 2618 in front of you. Test out the RAS a little bit. All right, here we go. We have our initial move up. We have our brief retracement. We have our double top right here. We have our break and close below structure, our lower low, lower close right here on this red candle. We can bring in our Fibonacci retracement once again. I don't think we're going to hit the 618 either. This one actually comes right to it. We would trace back to the 618, which also lines up with structure looking left. And we have our 2618 setup. So let's talk about how to enter. We know where to enter. We know we want to enter either at structure or a 618 Fibonacci retracement. Now we want to talk about how to enter, and there are two ways. Obviously, there's the aggressive way. If you want, you can just put a limit order at the 618. You can say, I'm going to sell it as soon as the market hits this level, and I'm going to get short. That's going to be the quickest way to get in every trade and the most aggressive way. With that being said, that's not always a good thing because, well, we'll see plenty of times where the market will just continue straight up, never stopping, and stop you out. A more conservative approach is going to be using the higher high, higher close, or the lower low, lower low, or lower low, lower close principles. So if we're looking at a trade, we have our double top right in here. We have our break below, close below. We're looking for a retest of our 618 or our structure level. Like always, we can even draw a little zone. We could take our 618 retracement, we could take our structure level and say this is my kill zone. Once price action retraces up to this kill zone, then we can look to get a lower low, lower close candlestick formation. And this was, again, something we brought up in the first session, I believe. So as soon as price action gets up here, we're going to get candles pressing up. Let me do my best to, let's erase this, draw some candles in here. It's the best I can do. That looks good. Let's make these blue. So this candle right here is the one that hits our trigger point. Our 618 hits our zone, 618 in the structure zone. You can also wait for a 20 or a lower low, lower close to get involved, meaning that before you enter this market, you need to see a bearish candle put in a lower low and a lower close than that trigger bar. So in this case, our lowest low on the trigger bar is at the bottom of our wick right here. So we would need a close on this candle that occurs below the bottom of this wick. Again, the same principles we learned with identifying trends, new structure highs, new structure lows, the same lower low, lower close technique, but this time we're going to use it to enter a trade instead of just identifying the market. So as long as the market keeps pushing up, we're still not involved. We're still not involved until we get that candle that gives us a lower low, lower close. Once we get that, we can enter next bar market and involve ourselves in the trade. So two entry techniques for you. One is an aggressive entry. One is just putting a limit order on the 618 or at that structure zone and saying I'm gonna get involved as soon as the market hits it. A second one is using the higher high, higher close, or in this case, lower low, lower close entry technique to involve yourself in the market. And again, there's pros and cons to both. If you're someone that is away from your computer, it's going to be harder to wait for this lower low, lower close, or higher high, higher close entry technique because you have to physically sit there and watch watch price action at market because we never know when we're going to get it. But it's also going to give you a little bit more confirmation that this market is indeed ready to reverse. Benefits of the aggressive entry? Well, you don't need to be by your computer. You can set it up, say in the beginning of the day, say I'm just going to buy or sell at this point, go on for your day and do whatever you have to do and come back and see if you're entered. You're also going to catch those opportunities where the market spikes up, just hits that level and then reverses right on the dime. The cons, well, there's no confirmation. So price action could easily just keep spiking up, and then stop you out. So there's pros and cons to each method. But we're gonna go with right now the less aggressive one, which is the lower low, lower close technique. So our entry is right here. For our stops, just like the double bottom and double tops, they need to be above the high of this structure zone. So remember, the wick is going to be counted as the highs. They need to be above the highs of this structure zone. You can take your 113 Fibonacci inversion. So take your Fibonacci extension tool from our swing low here to our swing high and back down. Bring in a 113 for a predicted stop level, or you can use the same ATR based stop like we learned about a lesson ago. Either way, and of course you want to test out whichever technique you decide to use, either way, it has to be above the highs of this double top. Now as far as targets goes, there's a few ways you can enter targets, and this is really this is a trading strategy that has a lot of customization, I guess. With a lot of our advanced patterns with the double bottom, double top setup, usually there's a suggested default target for this technique. This one you're going to have to test out, you're going to have to feel it out, and it depends on how aggressive you are as a trader. But the traditional way to take it is we're looking for price action to extend down. So we're looking for a 127 Fibonacci extension from this recent move. So from our move from our right top, our second top here, to the one that broke our most recent structure level, we're going to take our Fibonacci extension tool. We're going to take the swing high to the swing low and back up. And we're going to look for our 127 as being our target level. And you can see it offers a pretty nice risk reward. If we're entering right here, we have a potential reward of about this much. And with our stop loss right above our 113, let's call it right here, you can see we're only risking about half as much as we're willing to gain. And we'll see the same thing with a bullish one. See price action spike down. It's going to give us a double bottom. We break and close above structure, so higher high, higher close. As the market comes down here into our kill zone, we can bring our 618 in as well. So Fibonacci retracement from our second peak down here to wherever this structure, wherever this last leg ends. And as soon as we get a candle that hits that structure level or that 618 retracement, we're going to look for a higher high, higher close to enter. So we may see this. We may see the market push down, maybe consolidate a little bit. But as soon as we get this higher high, higher close, this candle right here, ugly looking candles, but you guys get the point. As soon as we get this higher high, higher close on this candle, then we're looking to enter next bar market. So our entry is going to be right here. For our stops, we know they need to be below our double bottom. Again, we can use ATR based stops. We can bring in our Fibonacci extension tool and invert it. So swing high to swing low backwards and look for that 113 Fibonacci level. Instead, we're going to put our stops right here. Where do targets need to go? Well, we take our Fibonacci extension tool from our most recent swing low to swing high, back up, and we can look for a 127 extension for target 1. And you can see, even with a deeper entry here, we're still going to get more than a 1-to-1 on our risk reward. Now, some alternate uses for targets. Again, there's a lot of things you can do with this. If you're less aggressive, you can look for your target ones at a retest of the structure level, looking left. This will often give you a lesser risk reward, meaning you may be risking more than what you're willing to gain. But when you do the back testing, when you run through it, if you notice the strategy is still profitable, then it's still worth trading. You can also predict the ABCD pattern. So you can take this initial move, copy and paste it, put it onto the retracement here. And in this case, it's going to be near the same level, but let's pretend let's pretend we didn't spike down that deep. Move these up a little bit. You can look for target 1 at an ABCD pattern completion. Or if you really get used to structure and you notice there's a major structure level looking left, you can base your targets off overall structure. Again, tons of things you can do with this. The traditional targets are going to be this 127 extension for target 1, and then this 1618 extension for target 2. But I definitely recommend, after you test this out, and you guys shouldn't be trading this at this point anyway, but after you test it out, after you train your RAS, reticular activating system, to get used to it, you can come up with an idea for, hey, what works best for me, and especially with my personality. If I'm a less risky trader, maybe I want to take more conservative targets. If I'm really good at structure analysis, I'm great at identifying major and minor structure levels, and I know that the market is gravitated towards them, maybe I'm that trader that shoots for for higher targets based on structure. It's up to you, and that's part of the process of growing. But to begin with, I would just base them off this 127 extension for target 1 and this 618, this 1618 Fibonacci extension for target 2. And if we look at our example here, works perfectly. We have our double top. We have our lower low, lower close right here. As the market pushes up, to our level, and this time you see its structure and our 618 right below our 618, we can start looking for our lower low, lower close. So the market moves, we get our initial high right here, we get our new high point right here. So we need the market to put in a lower low, lower close based on this red doji candle, based on this red candle. You can see, do we get it next bar? Nope. Boom. Right after that, you can see we get it right here. Market creates a lower low, breaks the low point of this candle, and obviously closes below it. So where will we enter? Right here. Next bar market. So here's our entry. Stops. We could take the Fibonacci inversion, so our Fibonacci extension tool, inverting it from this leg back to our initial top, or our second top, I guess you can say. Oop. Helps if I actually put in the Fibonacci retracement. We have our 113 right here. So stops go right here. Where do targets go? Well, let's take our Fibonacci extension from that same move, swing high to swing low, and back in. And we can look for our 127 as our initial targets. And you can see the market comes right down into there before retracing a little bit more and then eventually coming down to target 2. Now in this scenario, you can see our risk is going to be a lot more than our reward. So this may be a trade where you say, you know what, it's a valid 2618 trade. However, the risk just doesn't line up with what I'm looking for. The risk is too much to risk, and I'm for the little bit that I'm willing to gain. So you can just pass on. Again, that's if you're a trader that has that rule. We always preach you want to have a 1-to-1 risk-reward ratio, but it honestly depends on the trader. If your win percentage is high enough, you don't have to have a 1-to-1. When you guys learn about the cipher pattern, you'll see that on the lower time frames, we often don't get a 1-to-1 risk-reward, yet the pattern is still very profitable just because it wins 80% of the time or 75% of the time. So as you do your back testing, as you run through chart after chart after chart looking for 2618 setups, eventually you'll get a number of what percentage of the time does this pattern win? Does it win 80%? Does it win 70%? Does it win 60%? Does it win 40%? And based on those numbers, you'll be able to see whether it's worth taking a trade that has an inverse risk reward. And again, an inverse risk reward would be where what you're risking is more than what you're willing to gain. And again, those numbers come from your back testing. But this would be a scenario where you may just say, you know what, it's not at least a 1-to-1. I'm going to pass, and that's okay. Let's see if we can get another one here. 2618s. All right, this looks like actually, well, yeah, this one doesn't fail based on our stop. We'll take a look at this one, see if it works. So you can see we have our initial double bottom. Market spikes up. Actually, Market gives us our break and our close right around here. And this is going to be another one that doesn't have a risk reward that works pretty good. You can see we come back into our structure level. So if you're a structure-based trader, this is one you're going to take. If you're a trader that looks for the 618, well, then your entry is going to come a little bit later. So if you're a structure-based trader, here's what you're looking at. You're looking at your lowest point on this retracement, which is going to come right here. You're then looking for your higher high, higher close, which means you'd be entering the market right on this green candle, right after this green candle closes. Stops are going to be below our double bottom. Targets are going to be a 127 extension of this last move. And you can see once again, because we don't retrace too deep, you're going to be stuck with a horrible risk reward. Now, if you're a trader that looks at, I mean, it would have won, as you see it spikes up, but it would have been a horrible risk reward. Now, if you're a trader that looks for the 127 extension, or the 618 Fibonacci retracement, excuse me, then you're looking a little bit deeper. So you're following the market as it retraces up to this level. You're waiting for this move back down into the 618. And you're looking for a higher high, higher close of this candle right here. So if we zoom in some, and let's get rid of this. Let's get this out of here so we can see it clearly. Now we don't need this at all. You're looking for a higher high, higher close of this candle. So right now you're looking at this mark. Here's the high wick. You need a higher high, higher close of this level. Now, as this market continues, look what we do. We put in a lower low right here, making this the new candle we need a higher high, higher close above. We then put in another lower low here, making this the candle we need a higher high, higher close above. Finally, next bar market, what do? Well, we get it right here. Making our entry, unfortunately, at this red candle. So the market would have went straight against us, but we have our entry right here. Stops, we know stops are below our double bottom. So right around here. Targets, we're taking our Fibonacci extension tool from our swing low to our swing high, back down, and we're looking for that 127 extension. So I'm looking at a reward of about this much. And you see my risk is going to be about exactly the same, a little bit less than that, or a little bit more, I should say. But you're getting a more even risk reward to that first target. So that's one of the benefits of waiting for that 618. You're going to get a much better risk reward ratio. However, if you wait for structure, you may be able to catch some opportunities that you won't get by waiting for the 618. So it's going to be a decision that you guys are going to have to make. Sorry, but I can't make it for you. That's part of the trading journey. And you can see just following this along, the market ebbs and flows. We push up, we push down, we push up, we push down. Let's see if this actually wins. Again, I don't look at these charts before I scroll through them. I like to do it live for you guys. So we push down. You can see we retest the bottom of our initial double bottom. Never break, never close, never get near our stops. Looks like the weekend comes and we gap up. And let's see what the market does. There we go. Boom. Eventually, hitting target 1 at our 127 extension. And let's just see if we get a target 2 up here at our 161.8. Yep, target 2 hits. Would have been a 2 target winner. Now this would have been a painful one. And by painful, I mean one of those trades where it's going against you and you may be sitting in the red. You may be sitting at minus 20 pips for a few days. But eventually, it goes on to win. So that's the 2618 for you. Let's see one more example. One more example for you guys. Check out Kiwi. Perfect one right here. Beautiful. Again, I'm going to pause the tape for a split second and let's see if you can identify it. Okay, so here we go. We've got our initial move up. We've got our double top right here. Next, we're looking for our break and close below structure. Right here, we get our lower low, lower close on this red candle. We're now looking for a retest of the structure level and slash or that 618 retracement to be hit. And let's change the color of this as well. So you can see we have our 618 retracement right there. Price action comes right back into it. And we're looking for our new high mark, which comes right here. Here's our high candle. After identifying this high candle, we're looking for a lower low, lower close. So we find the low of this candle, which is right here on the wick. We're looking for a lower low, lower close of this candle for our entry. You can see that we don't get it on the next candle. However, on the candle after that, what do we get? Lower low, lower close. So we're entering the market right here, right on this blue line, next bar market. Stops need to go above our double top, so up here somewhere. And again, you can use ATR base, you can use the Fibonacci inversion, either or. Targets, we're looking for a 127 Fibonacci extension from our right shoulder, or our right peak, to our low point. Swing high to swing low and back down. And our 127 comes in right here. Potential reward. Potential risk. We get a pretty good setup on this one. As you can see, our risk is lower than our reward. And price action indeed shoots down to what? Our 127 extension. We retrace up a little bit and then eventually come down to target 2s, down at our 1618 for a beautiful target 2 winner, or target 1 and target 2 winner.